वक्त है खास इंटरव्यू का। दिग्गज टायर कंपनी सीएट के एमडी अनंत गोयंका ने हमारे सीनियर एडिटर अजय शर्मा से मार्जिन, कीमतों में बढ़ोतरी, कैपेक्स और ग्रीन इनिशिएटिव्स पर विस्तार से बात की। आइए सुनते हैं एक्सक्लूसिव कॉन्वर्सेशन के कुछ बात।
So Anant, let's start by understanding, the basics of the tire business as we see it right now. On the one hand, organizations such as yours have battled the very sharp rise in commodity prices, and on the other hand, demand perhaps wasn't that great that you pass on the entire pressure. How is the situation as we stand right now?
Right. So if you were to look during COVID times in the last year, we did face a slowdown, a sharp slowdown in the certain quarters where you had a wave 1 and wave 2 coming in. But we did have very fast pickup of the market last year, July, August itself. The markets rebounded back pretty well. On the other hand, we also had the benefit of raw material prices coming down in 2020. To that extent, last year was a very good year for us. Despite the Q1 slowdown, we grew by about 12%, and we're looking at a 41% growth this year on a year-on-year basis. So growth is coming along well, but this year we are having challenges of inflation. Crude has gone up by 70-80% at about $85 per barrel. The other key raw material we have is rubber, which is also up by about 40-50%. So to that extent, inflationary pressure is very high at this point of time, which is having stress on our margins.
So you have taken some price hikes, and some more perhaps may not be ruled out in the next couple of months?
Yes, so continuously over the course of this year, we've been taking price hikes ranging between 1 to 3% every other month. We have done so in the month of November as well, in some amount in December, and we will need to continue for the rest of the year.
How is the reception in the market? Is the demand buoyant enough to get all of that absorbed, or it's still slightly on the weaker side?
So it varies industry to industry demand. So I'd say medium commercial vehicle demand is gradually picking up as we speak. On the passenger car side, particularly on the automobile manufacturer space, they are facing the issue of chip shortage at this point of time. And on the two-wheeler side, there is a clear slowdown in terms of demand, whether it is because of rural demand being low, late harvest season, some amount because of COVID impact, where they had to dig deep into their pockets for the medical challenges that have come in, and also maybe people waiting for the exciting new EVs that are coming in. So there is a shift and wait for these new products that are launching.
Right. So industry watchers say that almost 50% of the thousands of auto ancillary companies which are operating in our country right now may not be in business over the next 5, 7, 10 years. But one sector which is kind of insulated by that is tires, because EVs also require tires, perhaps a different composition and sleeker or whatever, but EVs do require tires. How are you working with your EV clients, and give us some insights, because you've been ahead of the curve. You may be interacting with them at the design stage of their vehicles, right? So how are things as they stand?
Yes, we are fortunate to be one of the auto comp players that are not getting impacted to that extent, but there is a clear technology change that is happening between your ICE vehicles to EV vehicles, even with respect to tires. So if you look at the electric vehicle, it is far heavier. The weight of the battery makes the weight of the tire much more, which has an impact on the weight carrying need for the tire. The second is the noise. That component of the engine in an ICE vehicle comes down to zero when you move to an EV, and therefore the ratio of noise of the tire goes up to nearly 25-30% of the noise of the vehicle. So you have to work towards low noise technology. And then the nature of the vehicle itself is towards sustainability, towards clean energy, and therefore your tire also has to be made out of materials which are clean. It has to be low rolling resistance, which means it has to take up less battery power or better fuel efficiency. So the merger of these three technologies is what we are working on: more weight carrying capability, lower noise, and more sustainable. And we will be launching our energy drive vehicle, which is going to be our electric vehicle shortly for the car segment. Or for the two-wheelers, we have already launched. We believe also there is an order for progression that will happen in the case of electrification of vehicles. So first there will be e-rickshaws which have already got electrified, then you will have motorcycles and scooters, followed by government mandated buses and owned fleets, followed by cars, and then privately owned maybe trucks and buses. So we are very much focused on two-wheeler EVs. We are there with nearly 80-90% of the OEMs with a very strong share of business. So we are very much geared.
So you have over 50% market share already in two-wheeler EVs.
That's right.
What's the kind of discussions you're having? How large can EV numbers become for the sector, I'm saying, over the say next 2 years? Because they need to work completely in tandem with you, otherwise there'll be a mismatch of supply demand on the product side. So how does the potential look like over the next 24 months?
Right. So if you look at the tire sector, about 50% goes to the replacement market, which will not yet come in demand because there's not enough OEMs, EV OEMs on the road. So I'd say if you look at the 50% that is there, and let's assume, I mean, maybe today we are at under 2% electrification. Even if that doubles or triples, you're still talking at a very small share of electrification in the near term, in the next 1 to 2 years.
And 5 years?
But you do have players like Ola, Ather. Ola, for example, have spoken about over 1,000 crore sales in 2 days. So to that extent, if that is happening and you have so many vehicles coming on the road, it will be large, but I would say as a percentage of our own business, still maybe about under 10% in 2 to 3 years time at this point. But going forward, I'd say longer term, 5 years, 7 years, it can easily become 30-40% of our business.
Excellent. Let's take a step back once again and talk about your traditional business. I was looking at your commentary that utilization is still quite high across your plants, and even in the downtime of the last 2 years, you did not really scale back your capex in a big manner. So you are geared when the demand looks upward, your capex is actually coming on stream. Talk to us about your utilization and regular capex which is going on this year, H2, and some visibility of next year.
Sure. Now we are at about 80% capacity utilized until now. We would have done about 4,000 crore capex over the last say 6 years, of which about this year will be about 900 crores. And going forward, we expect it to be about 700-800 crores or so every year. That's the kind of approximate range that we are looking at. We have been largely investing in the passenger space. So first in the two-wheeler space, and then over time in the passenger space, we have a 2,000 crore capex plant in Chennai that we started off about 1.5 years ago. That is ramping up well. We've also invested in the off-highway tire space, which we are quite excited about. It's a high margin space, primarily farm tires that get sold in US and EU markets. And that space is an area that we also looking at. So over time, we will be investing in spaces that are, we feel, going to grow faster and higher margin. And we feel that with this capex, our mix will be far better and more favorable in areas where we are winning and where our margins are better.
That's a very interesting point which you said, because I was wondering why is CEAT not planning any big splash or incremental steps in that direction. One of your other players in the space have been, talking very good numbers in the export opportunity of this off-highway tires and large farm, which is actually US market, right? Even Europe.
Right.
How do you see the potential over the next 5 years to kind of market share potential, or what size and shape can this end of your business become in the next 5 years?
Yeah, so for us, international business has become very, very exciting. So one big part of it is the off-highway tire space, where margins can be anywhere between 17 to 25-30%, whereas the normal tire margins are somewhere between maybe 10 to 12%. So to that extent, this is a high margin space. We have been in this segment for the last 15 years, but not really added much capacity. So with this new capacity expansion, with our new capacity in the radial space also, it's a high growth space. There is also a labor arbitrage that does exist between US or developed economies and India, where India has established itself as a strong value player in this category of tires as well. It is also a space where China is relatively less present. So with low presence of China, it will make a difference where this value segment opens up for Indian players to supply into these two markets.
That's excellent input. And Indian players, probably that is why others also, and you're looking at garnering a lot of market share there.
That's right.
Let's move on from the operating metrics of a business right now to say a little slightly longer 5-year plan. I'm sure you guys also sit together and make short term, medium term and the big plans. When you had taken over in the MD's role, I clearly remember there was a quite shift of the organization towards growth, and market also loved it. I remember there was a spell of 14-15 months when the stock rallied very sharply. So what are the big strategic areas of focus for the company, or for 5-7 years far out? Where do you want to steer the company into? What kind of organization would it be?
Sure. So we want to exist to make mobility safer and smarter. And that is there largely because our play in the passenger space is very important for us. By passenger, I'm talking about two-wheeler and passenger cars. For us, our strength lies in our distribution. We have maybe multiples of sale points than our competitors, and that makes a big difference in the tire space, particularly in the passenger car space and two-wheeler space. So this area, we're looking at leveraging this and making sure and working towards how do we win in these categories. Also, our brand association with safety is very important, which is a unique or a specific need which is very important in India. Today you have two-wheelers where the rider is exposed to the road, and if anything goes wrong, you're talking about a risk of fatality out there. So our association with grip and safety is very, very important. So with these strengths, we are looking at winning in the two-wheeler segment, where our market shares have shifted from about 10-11% 8-9 years, 10 years ago, to now about 25 to 30% in the two-wheeler space. We are also seeing a very positive momentum in the passenger car space. In the last 3 years, we would have gained about 5 percentage points in market share, and we are looking at continuously taking that up going forward. So if our share of our own revenues can be maybe 40-50% or 60% in the passenger space, that would be good, and maybe another 20% coming in from the off-highway tire space, which we think is again high margin, great opportunity long term for sale in the US and EU markets.
That will be very interesting. I also understand that you guys have carved out an area of focus on B2B business, and that is fleet solutions. Right now, it's just from your dealerships and your stores, fleet operators just buy out the tires. But you are looking at a pocket of profitability which can be shared between the fleet owners and the company if you are able to mitigate some of the pilferage in the system. Talk to us about that opportunity. How much can it become? How important can that be? And how did the idea come to you?
Right. So I think there's a big shift towards buying products to buying subscriptions or services. And just the way you consume music, for example, we were talking about that instead of buying a song, you now buy a monthly subscription. Now, can we work towards a similar pay-per-use service in the case of tires, where you buy kilometers instead of buying tires, or you buy on a per kilometer basis? The other challenge we found is, again, for a commercial vehicle, they're looking at maximizing their own profitability. If they're looking at cost per kilometer or profitability, how do we not only increase profitability by giving them good quality tires that maybe last longer, etc., but how do you also work towards increasing their profitability at an overall basis? And when we went and spent time with them, we found that many fleet operators own maybe 3, 4, 5 trucks. They relatively work on high level heuristics, so they know that, okay, my truck tire will work for 5 trips between Bombay and Nagpur, and after that I have to change it. But can we provide them with data and show them what their true base cost is? How can we further improve their profitability through driver training, through providing them with enough visibility on areas where they can improve profitability, fuel efficiency, and so on. So we've created a fleet advisory module which is working towards improving profitability of fleet, which hopefully overall, as that improves, our own brand perception goes up, and we get more tire sales and provide them also with knowledge and capability.
So very interesting conversation, और आप ये पूरा इंटरव्यू 3:30 पे देख सकते हैं. अभी आपको सिर्फ हमने कुछ ग्लिम्स दिए हैं, लेकिन ये इंटरेस्टिंग कॉन्वर्सेशन आज